In this video, I want to talk a little bit about my Apple position. I want to show you what's going on right now and what I'm thinking. The first thing I want to do is I want to just point out we just closed out our strangle spread in Apple here, and as you can see down in the accounting, we had two options. We had a call option and a put option. Of course, I put those right at the exact same price. Well, they were a little bit apart, $9.95 and $10, so it was actually a strangle rather than a straddle. And as you can see, the market rallied, and the call option came in here at $1,000 profit, and the put lost $590. So that's due to convexity. And if you're not familiar with convexity and delta and how that works and why the one lost less than the, even though they were at the exact same price, why one lost less than the one that it made, then you need to get a hold of me and contact me and let me help you with that. But that's how strangles work. Strangles and straddles, okay? And so those are a couple of my favorite strategies. And so what we did is we rolled those out, took the profits, and since there's no commissions, we can go ahead and reset or roll over to the next decision point. I feel like this is the next decision point, and I'm going to show you why. First of all, I want to do a couple of Fibonacci projections, then I'm going to do some Gann work, and then I'm going to show you why I put this new position on and what we're anticipating there. So the first thing I want to do is I want to come in and I want to go back in time a little bit. And I just want to do a Fibonacci projection in here. And this market has been rolling very nicely through a nice level trend. And so as you can see, this market went down from the A point to the B point, rallied back up to the C point. Now, obviously, this is on a long-term basis. This is over a series of months. So this is about a year's period of time. So over the last year, the market fell, it rallied, and it fell once again. Now it's coming down off of this pullback. When we come down to the 50% retracement level on that Fibonacci projection, as you can see, that's right where it bounced off that low point and started to rally once again. Now, there's several things that we can do. We can anticipate that this market's going to then turn right around here and drop once again and come down and test these lows with another leg down. We can come down here with the Fibonacci 1, 2, 3 tool. There's 1, 2, 3. And look for this market to drop down here and test this 100% level down here, 130, which would be a breaking of the previous low down here. Now that's if the market turns right there at that C point. If that market continues to rally, we'll have to move that a little bit to make those forward projections. But there's something I want to show you here. The other thing that we need to take into consideration, and let me remove these drawing tools, is the upside potential. So what if the market rallies, goes up, this is just a pullback, right? And this is actually a rally. And the market's just going to pull back a little bit, bounce off maybe this area of support here, and then rally and break new highs. It could easily do that as well. All right, and that's what we traded on initially as we got in down here on this decision point, the rally point. The market rallied, and that's where we ended up with our $500 profit in here, or $400 profit, I guess. We lost the $590 on the put, which was our insurance policy. We made money on $1,000 on the long call. Now, yes, of course, had we not put on the put, we just picked up the call, we'd have made the full $1,000, but then we wouldn't have been protected to the downside. It depends on your risk tolerance and how aggressive you want to be in the markets. Okay. The other thing you could have done is said, well, I want to make more money than that. Well, buy two. I only bought one. Okay. I bought one call and one put. You could buy two calls, two puts, and it'd have been, just double what we've got here. And then you say, well, I still want to make more. Well, then you got to take more risk. Greater risk, greater reward. Okay. I like to trade oftentimes, these decision points. I have a course that's coming out. I'm working on it. It's called Decision Point Trading. And in that course, I talk about these decision points. And I talk about which ones we can be more aggressive with, which ones are less aggressive. And I show you how to trade the less aggressive, the more aggressive. And we actually go through and categorize them, and we decide which ones are more aggressive, less aggressive, which ones we can take higher risks on and lower risks, and I show you how to do that. So watch for that. It'll be coming out soon, called Decision Point Trading. And that's what we do here. We wait for these markets to get into decision points, and then we determine the strategy that we're going to use to take advantage of that decision point. So now in this case, this market has rallied up here, and it's coming to another decision point. And it's like, why is that a decision point? Well, first of all, I'm going to show you something. Here's one more thing I want you to be aware of. Let's come in here, and I want to show you the Gann Fan. All right, we're going to come in and we're going to grab the Gann Fan. And I'm going to go from this low point to the high point. I'm going to square the chart. I'm going to square the Gann Fan, and I'm going to draw that out there. And if you notice, let me come in here and make this a little bit easier to see. I'm going to turn that Gann Fan, go into the preferences, and we're going to make that a little bit lighter color so you can see a little better. And see that 3x1? that 3x1 line and that 2x1 line, that market went right up through that 3x1 line and used it as an area of support all the way across the bottom there, right up through that line, right up through there. When it broke that line, it started to fall. Now, Gann has a theory. The reason that this is this way is because if the market starts to go up, it's supposed to stay, according to Gann's theory, it's supposed to stay between 1x2 and 2x1. It's supposed to stay right in there. Okay, this is called the cone of probability in here. This is where the market should stay if it's a normal trend. Okay, but this market was a little weak. This entire retracement was a little weak. It lasted for about 4 months, and then it fell out the bottom. So this was kind of a predictive measure by Gann, saying this market, even though it's accumulating, it's in accumulation mode, as you can see by the bulls and bears. We have our red arrows, which are accumulation arrows. That's the way I've got the bulls and bears turned on. If you want to see the settings for that, here they are. You can pause the video and go down through the settings. And I have arrows in all color changes, which is the accumulation mode. Okay, you can use either Keltner bands or you can use traditional on these long-term charts. Either way, I like both. But this is what gives you the accumulation arrows. And you can see that we got a reversal arrow right up in here as it broke that Gann line at that 3.1. So this trend was actually a little weak. It never did get up into the 2.1. It broke up in there a little bit here at the beginning and then came back down and used the 3.1 as the area of support up that whole thing. So it was kind of like a weak trend anyway, and then it broke. When it broke, it fell quite hard, came all the way down to 8.1, started to rally. Now I'm going to come in here and reverse this Gann Fan, and we're going to come in and I'm going to just enlarge the charts a little bit so you can see it a little bit better. And I'm going to put that Gann Fan in here, and we're going to go from the peak down to the bottom, and again I'm going to square it by holding down the control key. That squares the chart, and as you can see, it comes down here. It's staying perfectly within the 2x1 and the 1x2. All right, it's right inside that cone of probability that Gann predicts. The market staying in there, and then broke the 2x1 and went up to the 3.1. This is why I liquidated my long position. All right. Now, it doesn't mean the market can't continue to rally. It certainly can, and we've seen it do that on many occasions. But when we're trading, we don't trade what it could do. We trade the probabilities, and we try to stay within that cone of probability. And so this market's gone what we call too far too fast. Okay, so it's rallied a little bit too far, a little bit too fast. We were up $500, so we took our profits. We took the money off the table as it reached up into this 3.1, looking to go up into that 4.1 region on the Gann Fan. It's just a little bit too high, a little bit too far, a little bit too fast. It hasn't digested this run. So actually what we're doing is we're looking for this market to rebound and fall a little bit, even if it wants to continue. I'm not saying that Apple is not going to go on this big, massive run and go up, break all-time new highs. It certainly could. And this could just be the pullback down in here, this taking profit as it reached back to the 50% level of the last major move, start to rally once again. Now, oftentimes what we see when a market rallies like this, it'll fall back down to the 50% level, and then it'll kind of go sideways, all right, trying to determine whether it wants to be bullish or bearish and get some kind of a fundamental push underneath it to drive it one direction or the other. So at this point, because of this Gann Fan, we took our profits and we rolled our position from down here where it was up to this new position. Now, you don't have to do that. If you're trading on a platform that has commissions, you probably don't want to do that because you're rolling like that's going to probably eat you alive on trading when you've got when you have to pay commissions. But we're trading on a platform. This is a no commission trading platform. It's real live money, and I don't have to pay commissions. So I don't have to say that, does not include commissions and fees, because there are no commissions and fees when trading through this platform. So we can roll our options like this and be a little bit more aggressive. We don't have to be so conservative when rolling because there are no commissions and fees with our options, and that's just the name of the game. When you're having to pay commissions and fees, you can't roll like that because you'll get chewed up alive rolling constantly with your commissions and fees. So here's just an advantage of this. So we rolled our position up from where it was to where it's currently trading to this new decision point. And this decision point is not a high probability decision point. So I've got on here another spread. It's a straddle on here, and so we're going to put a little option straddle on here. And if we come over to open positions, you can see we did the same thing before as we did before. We did 1 and 1. Here we did 1 and 1 again. So right now we're up $11 on the one. We just barely put this on. So Our put is up 11 and our call is down 250. And again, that's due to convexity. Convexity is not really taken much into consideration right now just because we just barely got into the market. But a little bit. The market started to fall against that resistance point, the 3.1 on the Gann Fan. And again, that Gann Fan is set in there, it's squared to the market, and that's kind of an area that we look at as a resistance point if the market runs too far too fast and jumps up into there. Doesn't mean the market can't travel down through there once it gets to that point, but it generally goes up into that region up in there, and then it falls back down. So that's what we played against, and that's why I did what I'm doing. All right, so that's just a quick strategy that we're looking at with Apple. I'm anticipating just a fall back down into this region here, maybe an ABC 1, 2, 3, something along those lines. We could do an ABC, anticipate a continued rally, but we'll watch and see. We don't know. We're going to see what happens with these options and see where the areas of support and resistance come in. But that's kind of where we sit with Apple. If the market does continue to rally and go long in the next couple of days, no problem, because we're covered with the call. But if it falls, as it seems to be doing and bouncing off this resistance point, we're covered with the puts. If you'd like to learn some of these decision points for yourself, swing by my website, www.tradementors.com, and we'll teach you how to do this for yourself.